Alright, so guys, in this video, I'm going to teach you how you can adopt proper money management so you don't freaking blow your account. Let's talk about that today. Point number one, I need you to start thinking about indicators, because if there's two traders today, let's say the first trader has a 90% win rate and then the second trader has a 50% win rate, okay? And if I'm to ask you, which one do you think will become more profitable? Depends. But if I tell you the first trader who has a 90% win rate, don't even bother about risk management, and then the second trader, even though he or she has a 50% win rate, but he or she manages his risk properly, which one do you think is going to be more profitable? Of course, the one with 50% win rate. So I don't care if you have a super high win rate strategy, if your risk management just is not on point, then I can tell that nothing is going to change. But the sad fact is that in this industry, a lot of people, they just focus on indicator strategy. Like, if they are not profitable, all they think about is maybe because my strategy is not good. Then they go out there and find strategies. Then the worst thing is that those people who are selling you signals, all they talk about is strategy, because they know that this is what sells signals. This is what sells their products. But when you talk about things like boring money management, risk management, who's going to listen to that, right? And if you're a beginner trader, you might not understand how come strategy is not the secret to success. When you are an experienced trader, you will understand the importance of risk management. Chances are most people, they won't value risk management, money management until they have blown their accounts. Because this is how I eventually understand the importance of it. Once I've blown tons of accounts, lost tons of money, then I was like, my mentor, you were right, even though right now it's too late. Now, of course, having a good strategy is very important, but then way too many people, they feel that this is their only solution. I get emails from people and then they be like, Karen, I'm not profitable. Can you give me a good strategy? I've never ever received an email where people are like, Karen, I am not profitable. Can you teach me good money management? Of course, if your strategy sucks shit, then of course you won't make money despite having good risk management, but it's not as important as you think it is. So how do you know whether your strategy works out or not? You gotta apply the expectancy formula. I've done this in a previous video, but if you haven't watched it, this is the formula. Okay, use it to calculate and determine whether your strategy works or not. If you have a negative expectancy, then you gotta work on your strategy. Then you gotta find a good strategy to use. But if you have a positive expectancy, stop going up there and finding the holy grail, which doesn't exist. The next thing you need to do is to determine your risk tolerance, because your risk tolerance is going to determine what kind of time frame you trade, what kind of system you use, what kind of system you trade with. It's going to determine how often you trade, what currencies you trade, what currencies you don't trade, what you invest in, what you don't invest in. So how do you determine what is your risk tolerance? You need to look at your past history. For example, if you like to dabble into futures, Bitcoin, options, volatile penny stocks in the past, then it kind of tells you that you have a high risk tolerance, or you're just really ignorant because you don't care about risk. But chances are you are somebody who can tolerate risk. But in the past, if you have dabbled in things like bonds, mutual funds, then you're more on the low risk side. When you determine your risk tolerance firsthand, everything else becomes easy, because you would be able to understand how much are you risking in every single trade. And also you'll be able to calculate your lot size properly. You would be able to calculate, okay, what is my estimated ROI at the end of this month, at the end of this year. And also the thing is, the amount of risk you take also depends on your lifestyle. Like if you want to pay off a retirement home, like for the long term, then you can afford to take less risk. Okay, then the next tip I have for you is you gotta learn how to use different order types to manage your risk, because what a lot of people don't tell you is you can use market order, limit order, stop order, in such a way that you can limit your risk. So for example, when you have a target price of 400 points, okay, and when the price moves up to the 200 points level, you are in the money, then what you can do is that you can move your stop loss to break-even level, so that your trade in a way becomes risk-free. And if you are trend forward, if you trade long term, you don't have the time to keep on shifting your stop loss and then monitor the charts. What you can do is that you can use a trailing stop, so that you don't have to monitor the freaking chart all the time, and so that you can live like a normal human being. So you need to learn when should you use market order, when should you use pending order. For example, what our traders do is that when they want to wait for a confirmation candle, so they are not going to enter now first, they want to wait for confirmation signals. So they are going to put a buy stop on top, so that when the price does go up, they get a confirmation, then the trade would be executed automatically. And also another popular strategy that a lot of traders use is when they trade breakouts, for example a breakout downwards in a sell market, then they are going to put a sell stop below the current price, so that they don't have to monitor the charts all the time. And the next thing I need you to do is, before you open a trade, please go and calculate your lot size, because I know a lot of people, they don't bother calculating. And in this industry, I don't know what happened, like people who overexpose themselves to risk, they are like freaking worshipped. Like, oh my god, you're so brave. Every single time before you open the trade, do you even bother to calculate your lot size? If your answer is no, then that explains why you're not making consistent money. Because something as simple as calculating lot size, you're too lazy to even do it, then how do you expect yourself to make money from Forex markets? When you're coming into this industry, do you know that you're competing with some of the smartest people who are super good in finance, in maths, in economics, and you're here be like, I don't have no time to calculate freaking lot. Do you know for professional traders, before they open a trade, they need to do so many graphs, Excel sheets, calculations that you don't see behind the scenes? And you have a problem with calculating freaking lot size? Think about that. Think about that. I know a lot of people, they don't calculate because they just estimate, okay, my account is 10k, estimate, okay, think, one standard lot. I've seen somebody who teach trading with a $5,000 account, he's trading one standard lot. What? And he be like, nobody is more brave than me, okay? That's why you should buy my signals. If you see somebody who don't even do proper lot size management, and you go and learn from them, then I wish you good luck. So the next tip I have for you is very important. You need to stop thinking that, okay, I need to take a lot of risk for me to be able to earn a lot of money. Instead, you need to shift your thinking and think in terms of, okay, how can I take the least amount of risk and then gain the maximum profit from that level of risk? Is this risk worth it or not? So if you study finance, you will come across this term called Sharpe ratio. And if you look at your statements, underneath most MT4 platforms, they have this thing called Sharpe ratio. So what is a Sharpe ratio? So basically, Sharpe ratio is a measure of how much returns can you get for each unit of volatility, for this amount of risk that you are exposing yourself to. So this means that the higher the Sharpe ratio, the better your risk-adjusted returns are. Okay? Again, it's not about returns, it's about risk-adjusted returns. What is the quality of your returns? That is most important, because a lot of retail traders, all they think about is, okay, what ROI am I getting? Like if you are risking your freaking whole entire account so that you can get a 50% ROI, is that even worth it? Because if you look at how Sharpe ratio is calculated, your returns, it takes into account the risk, okay? So Sharpe ratio formula, to those nerds, is equal to RP, returns of your portfolio, minus RF, which is your risk-free rate. Now a lot of people use US Treasury securities as a risk-free rate, divided by standard deviation. Now standard deviation, it is used to measure risk in finance. Basically, this is the standard deviation of your portfolio. So the overall formula gives you the Sharpe ratio number. So what is a good Sharpe ratio number? If you have anything more than 1, then you're all good. If you have anything more than 2, then better than good. Anything more than 3, excellent. So Sharpe ratio is also a measure of volatility because volatility means risk. Okay, so if I'm to ask you, portfolio 1, it has a high volatility, then the average return per year is 20%. Then portfolio 2, you're exposed to low volatility, but then the returns are the same. Which one do you think has a higher Sharpe ratio? The answer is the second one. So you gotta stop thinking about, okay, it's all about win rates, because studies have shown that traders who use a risk to reward ratio of 1:1 or higher, meaning that their take profit is wider or at least the same level as the stop loss target. Never stop loss wider than the take profit. Studies have found that traders who use a risk to reward ratio of more than 1:1, of at least 1:1, is 30% more profitable than other traders. A lot of retail traders, way too many, they be like, Karen, I have a 90% win rate, am I a good trader? I'm like, I cannot tell. Like, you gotta give me more context. How much risk exposure do you have? What is your risk to reward ratio? Like, what is your money management like? Like, the thinking. Stop thinking like a retail trader. Like, it's all about win rate, like it's all about strategy, indicator, it's all about returns, ROI. Just stop. If you learn from the wrong kind of people, I don't care who you learn from, if you learn from the wrong kind of people, it's like the blind leading the blind. Oh, look at me, I have a large lot size, so you gotta worship me. Now, if you want to learn how to calculate your lot size properly, how to determine your value per pip, and all those stuff, I've done a pretty old video. You can go and check it out. So with that, I'll talk to you in the next video. Bye.